Today we're jumping into something pretty specific, a really disciplined plan, aiming for a comfortable seven-figure retirement. And the timeline, just 25 years.
Yeah, and crucially, this isn't about luck or some huge inheritance. The sources we looked at are all about the math, the habits, things anyone can potentially do.
Exactly. It's framed as a practical guide, calling it a millionaire future, built on, well, what they term a middle-class income.
Right. It tries to cut through the noise, get down to a formula that's predictable, repeatable.
So our goal here is to really break down this plan for you, get into the mechanics, the how and the why, and the starting point, the absolute first thing the sources hammer home.
It's that classic idea. Paying yourself first. Sounds simple, but mastering it is rare. It's not just a good idea in this plan, it's presented as the fundamental requirement. Without it, the numbers don't work.
Because most people, how do they do it? Paycheck comes in.
Rent, mortgage, food, maybe some fun, and then save whatever's left over, if anything.
Which is often nothing, right?
Exactly. Savings becomes the leftover category. Paying yourself first flips that entirely. The savings contribution has to come out first, automatically. Like it's a tax you can't avoid or a really important bill.
We're prioritizing future you over takeout tonight.
That's the psychological switch. That's what separates the savers, potentially, from those still working at 70.
Okay, let's dig into that habit more. Calling it a mandatory bill. What did that actually do psychologically?
Well, it fundamentally changes how you perceive your own money. If that savings amount is whisked away automatically on payday,
your checking account balance just shows you less.
Right. You adapt your spending to what's actually there. You never had the chance to miss that saved money because, in your mind, it was never available to spend.
It short-circuits that impulse to spend what you see.
That's the idea. It bypasses willpower, which is, let's face it, unreliable for most of us long term.
Okay, so habit first. Lock that in. Then we need the numbers. The metrics driving this 25-year timeline.
The model uses a specific baseline, an average Canadian income of $75,000 a year.
Which is key, because it makes it relatable, not some plan only for high flyers.
Exactly.
Yeah.
And the savings rate they pinpoint, the sweet spot.
15%.
15% of that gross income. That's the target.
All right, let's translate that. 15% of $75K. What's the actual dollar amount you need to save each year?
That comes out to $11,250 per year. Every year for 25 years.
And breaking that down monthly for that automatic transfer we talked about.
You're looking at about $940 a month, give or take a couple of bucks.
So that $940 becomes priority number one in the budget. Non-negotiable.
Absolutely. But importantly, the plan doesn't assume you're starting from absolute zero.
Ah, right. There's an assumed starting point, a bit of a head start.
Yeah, a realistic one for many people who've maybe worked a few years, maybe got some company matching. The model assumes you've already got $25,000 saved and invested.
Okay, $25,000. And how's that split up in the Canadian system?
It assumes $20,000 is already in an RRSP, or Registered Retirement Savings Plan, and the other $5,000 is in a TFSA, the tax-free savings account.
We'll get into why that split later, I assume.
Definitely. It's strategic. But the main thing for now is that initial $25K. It means that compounding, the engine of growth, starts working on that sum immediately, before you even add the first $940 payment.
Time is already on your side.
Speaking of that engine, the whole plan kind of hinges on achieving an 8% average annual return.
Okay, 8%. That sounds ambitious, maybe. Especially when people see savings accounts paying, what, 1 or 2%? How do the sources justify that?
Well, it's grounded in long-term historical market data. They're very clear. You won't get 8% every year. Some years will be down, maybe significantly. Others will be way up.
Ups and downs are expected.
Right. But the argument is that if you hold a diversified portfolio, think a mix of stocks and bonds over decades, especially within tax-advantaged accounts like RRSPs and TFSAs, that 8% average has been historically achievable.
So this isn't about picking hot stocks or timing the market.
No, not at all. It's about broad market exposure, like low-cost index funds or ETFs that track major indices, capturing the average growth.
And the key ingredient is time, letting those averages smooth out the bumps.
Exactly. If you look at something like the S&P 500 over rolling 20 or 30-year periods, including dividends, the average often exceeds 8%. The longer you stay invested, the more predictable the average becomes, historically speaking.
You trade short-term volatility for potential long-term growth.
That's the trade-off. To illustrate how powerful this is, the guide uses that classic rule of thumb. The rule of doubling.
The rule of 72, right?
Yeah, basically. Divide 72 by your expected return rate, and that tells you roughly how many years it takes for your money to double.
So at 8%, 72 divided by 8 is 9.
Roughly 9 years for your money to double. It's a simple way to grasp exponential growth.
Okay, let's apply that just to the starting $25,000. Forget the new savings for a second. Just the power of compounding on that initial amount.
All right. Year 0, you start with $25,000. By year 9, thanks to compounding where your earnings start earning their own earnings, that $25K grows to roughly $50,000.
Double.
Then by year 18, another 9 years later, it doubles again. So now you're looking at over $100,000.
Just from the initial $25K.
And by year 25, even without adding another cent, that original $25,000 could grow to over $200,000 on its own.
Wow. Okay, that vividly shows the difference between simple interest and compound interest.
It really does. That's the engine warming up. Now, imagine adding fuel to that fire. What happens when you combine that $25K base, which is already working hard, with that disciplined $11,250 contribution every single year?
That's where things should really take off.
Exactly. The contributions start leveraging a bigger and bigger base. The growth curve starts to look less like a line and more like a hockey stick.
Okay, let's run the numbers. This is the core of it. 25K start, $11,250 added annually, aiming for that 8% average return over 25 years. Walk us through the milestones.
Sure. And it's important to manage expectations early on. In year 1, after adding your $11,250 and getting maybe 8% growth on the total, your balance is only around $38,000 or so.
Feels slow. You've put in over $11,000 plus the start, and the growth is only a few thousand.
Exactly. The initial years are mostly your contributions doing the work. This is where people often lose motivation and quit.
Got to push through that. What about year 10? A decade in. Does it feel different?
Oh, yeah. By the end of year 10, let's break it down. You started with $25,000. You've added $11,250 each year for 10 years. That's $112,500. So your total contributions are $137,500. That's the money you put in.
Okay, $137,500 out of pocket, so to speak. What has the market done by then?
The investment growth, the 8% compounding effect, has added approximately $77,000 on top of that.
So the market's contribution is getting substantial. Not quite matching yours yet, but getting close.
Right. Your total balance is sitting around $214,500. The growth is definitely pulling its weight now. It feels like your money is working alongside you.
That must be a good feeling. But the sources highlight year 20 as a really big deal, the inflection point.
Absolutely. This is often called the crossover point. It's huge psychologically and mathematically. By the end of year 20, let's look again. Your total contributions. The initial $25K plus 20 years of $11,250. That's $250,000.
So $250,000 saved through discipline over 2 decades. That's serious committed. What's the market added by now?
Get this. The investment growth portion has ballooned to roughly $498,000.
Wait, hang on. You put in $250K and the market added almost $500K.
Nearly double what you contributed. That's the crossover.
Your money is officially working much harder than you are at saving it.
Precisely. The balance is now around $748,000. And because the base is so large, that 8% growth each year is adding massive dollar amounts. The acceleration is incredible.
Okay, bring us home. Year 25. The finish line for this plan, what are the final numbers?
Right, the final breakdown. Total contributions over 25 years. The initial $25K plus 25 times $11,250, that's $306,250.
Okay, just over $300K personally saved over a quarter century.
But the investment growth, the heavy lifting done by compounding, that adds up to approximately $976,000.
Wow. Almost $1 million generated by the investments themselves.
Bringing the final projected balance to roughly $1,282,000, over $1.2 million.
And the key takeaway here, this was achieved on that average $75K salary. No windfalls, just discipline and time.
That's the core message. It makes that $940 a month, which might feel tough, seem completely worth it in the long run.
Okay, reaching $1.28 million is amazing, but how much do you keep after taxes? That's where the strategy gets smarter, right? Using those Canadian accounts, RRSP and TFSA.
Absolutely critical. You can't just do this in a regular investment account. The tax drag would kill your returns.
Explain that. What's tax drag?
Well, in a non-registered account, you pay tax every year on any dividends, interest, or realized capital gains. That takes a bite out of your returns, meaning less money is left to compound. It slows the whole engine down.
So RRSPs and TFSAs let you avoid that annual tax bite.
Exactly. They let the compounding engine run at full speed, sheltered from tax. They use the tax rules to your advantage. It's like a government subsidy for saving.
Okay, let's break them down. Start with the RRSP Registered Retirement Savings Plan. What's its main superpower?
Immediate tax relief. Tax break today. When our 75K earner puts, say, their $11,250 into an RRSP, that amount gets deducted from their income before calculating tax.
So they earn 75Ks, but they only pay tax as if they earned $63,750.
Correct. Which means come tax time, they get a refund, a significant one.
At that income level, maybe in a 30% marginal tax bracket, that $11,250 contribution could mean a refund of, what, around $3,375?
Easily. That's cash back in your pocket now. Plus, inside the RRSP, all the investment growth, dividends, capital gains, it all grows tax deferred.
Deferred, meaning you don't pay tax year after year.
You only pay tax when you take the money out in retirement.
And the bet there is that you'll be in a lower tax bracket in retirement than you were during your peak earning year.
That's the typical strategy, yes. If you retire and your income drops, the tax rate on those RRSP withdrawals should be lower than the rate at which you got the refund. It's tax arbitrage over time.
Okay, that's the RRSP. Now, the TFSA tax-free savings account. How's it different?
It's kind of the mirror image. With the TFSA, you contribute with after-tax dollars.
So no upfront tax deduction or refund like the RRSP.
Nope. The money going in has already been taxed. But here's the magic. Everything inside the TFSA grows completely tax-free. Dividends, interest, capital gains, zero tax. And the biggest benefit, withdrawals in retirement are 100% tax-free.
Completely tax-free. That sounds incredibly useful. No tax bill on that income stream.
Hugely useful. It gives you super flexible income in retirement. And importantly, TFSA withdrawals don't count as income when calculating eligibility for certain government benefits like old age security, OAS.
So it helps avoid potential clawbacks on those benefits. That's clever.
It's clean money in retirement, great for topping up income or handling unexpected expenses without worrying about the tax impact.
So two powerful tools: RRSP, tax break now, tax later; TFSA, no tax break now, no tax ever. How do you decide where to put that $940 each month?
The smart strategy, according to the sources, is often dynamic. It changes over your career. Early on, when your income is rising, maybe hitting that 75K mark, you're likely in a higher tax bracket. So maximizing RRSP contributions makes sense.
To get the biggest immediate tax refund.
Exactly. You get more bang for your buck from the deduction. Plus, your RRSP contribution room is usually larger based on your income.
And then as you get closer to the 25-year finish line, closer to retirement.
The advice often shifts. In the last 5-10 years, you might focus more on filling up your TFSA room. This builds up that bucket of completely tax-free money just before you need to start drawing it down.
So you end up with a mix: some taxable RRSP income, some tax-free TFSA income.
That's the ideal scenario for tax diversification in retirement. You don't want all your eggs in the taxable basket. This approach gives you flexibility and control over your retirement tax bill.
That's much more sophisticated than just saving. It's about tax-efficient saving.
Right, so we've got the habit, the math, the tax strategy. But let's be real, finding $940 a month on a $75,000 salary, especially with housing costs and everything else, it sounds tough.
Yeah, that's the easier said than done part for a lot of listeners, I bet. We need concrete ways to actually free up that cash.
The sources offer practical tips. We mentioned automation, setting up that pre-authorized debit for the $940. Let's reemphasize why that's so powerful.
It takes willpower out of the equation.
Completely. No debating yourself each month. The money's gone before you can touch it. You naturally adjust your spending to the lower amount left in your account. It forces discipline without feeling like discipline every single day.
Okay, automation is step one. What's another lever the sources suggest pulling?
Using that RRSP tax refund strategically, this is a brilliant way to boost savings.
We figure that refund could be around $3,300 or so. Most people see that as bonus money, right?
Yeah, for a trip, a new TV. But the blueprint says, no. Take that refund and immediately put it straight into your TFSA.
So you're using the government's tax refund on your RRSP contribution to then fund your tax-free TFSA savings. That's clever.
It's like recycling tax savings into more tax savings. It gives your annual savings an extra kick beyond the planned $11,250, and it helps fill up that TFSA faster, aligning with that dynamic strategy.
Okay, automate savings, reinvest refunds. What about managing spending itself, especially when you get a raise?
Lifestyle creep, the silent killer of savings goals.
You get a raise, you feel you deserve a nicer car, a bigger apartment.
And suddenly your expenses rise right alongside your income, leaving nothing extra for savings. The sources stress, when you get a raise, commit to increasing your savings percentage first.
Before you upgrade the car or the vacation plans.
Right. Maybe half the raise goes to savings, the other half to lifestyle, or even more to savings initially. You have to consciously decide to let your net worth grow faster than your spending.
Living below your means, even when your means increase.
It sounds simple, but it requires active choices. Otherwise, you just stay on that financial treadmill, earning more but not getting wealthier.
And finally, finding that initial $940.
Right.
Where does it come from if the budget feels tight now?
The sources talk about tackling hidden spending, the stuff you pay for often without even thinking about it. Subscription jungles, multiple streaming services you barely watch, apps you don't use. Convenience costs, those daily fancy coffees, lunch bought out every day, food delivery fees that add up like crazy.
Uber Eats is expensive.
Incredibly. The sources suggest most people, even on $75K, could probably find $300, $400, maybe even $500 plus a month just by tracking and cutting back on this low-value, high-friction spending.
So track your spending for a month, really see where it's going.
Identify the leaks, cut half the streaming services, pack lunch 3 times a week, make coffee at home. Suddenly, you might free up $400, $500 a month. That gets you a long way towards the $940 goal.
It requires effort, maybe a zero-based budget approach for a bit.
But the money is often there, hidden in plain sight. Redirecting it makes that compounding work even harder.
Okay, fast forward 25 years, discipline paid off.
Yeah.
You've got the $1.282 million. Now what? How does that translate into an actual retirement lifestyle?
This is where we look at withdrawal strategies. The standard starting point is the 4% rule.
Explain the 4% rule. Where does it come from?
It's based on historical studies, famously the Trinity study. It suggests that you can likely withdraw 4% of your portfolio's initial value in your first year of retirement, adjust that amount for inflation each year after, and have a very high probability of not running out of money over 30 years.
So it's a guideline for a sustainable withdrawal rate.
Exactly. A rule of thumb to estimate how much income your nest egg can safely generate.
Let's apply it. 4% of $1,282,000.
That works out to about $51,000 per year. Income just from your savings.
51 grand a year, that's a solid base.
A very solid base. But in Canada, that's not the whole picture. We need to add the government benefits you've likely earned.
Right. Canada Pension Plan, CPP. What's a reasonable estimate for someone working 25 years at that 75K level?
Based on consistent contributions, you could reasonably expect CPP to provide somewhere in the range of $12,000 to $15,000 annually, maybe more depending on exact contribution history.
Okay, so add, let's say, 13K on top of the 51K. We're at 64K.
And then there's Old Age Security, OAS, available to most Canadians over 65.
How much does that add?
Currently, that's around $7,800 a year. And remember, having that tax-free TFSA income helps ensure you receive the full OAS without clawbacks.
Okay, so 51K from portfolio plus 13K CPP plus $7.08K OAS.
You're looking at a total potential retirement income of around $71,000 to $74,000 per year.
Wow. That's almost matching the $75,000 working income.
Exactly. But without the 9-to-5 grind, the commute, the saving requirement, that's the payoff. Financial freedom achieved through discipline.
Now, the 4% rule isn't bulletproof, is it? What are the caveats or risks the sources mention?
The main risk is called sequence of returns risk.
Meaning
When you get your returns matters, especially early in retirement. If you retire and immediately hit a big market downturn, say, your first few years see negative returns, withdrawing 4% from a shrinking portfolio can really damage its long-term sustainability.
So bad luck with timing can hurt, even if the long-term average is fine.
Right. It's why financial advisors often recommend having some cash or very safe investments set aside to cover the first year or two of expenses, so you aren't forced to sell stocks during a crash. The 4% rule is a good guide, but needs careful implementation.
Okay, that's the successful outcome. What's the flip side? The risk of not doing this. What if someone listens and thinks $940 is too much and only saves sporadically, say, $2,000 a year?
The difference is stark. It's devastating, actually. Saving just $2,000 a year, even at the same 8% return for 25 years.
What does that end up being?
It only grows to about $150,000 total.
$150,000 versus $1.28 million.
Yeah.
That's a huge difference.
Massive. And if you try to live off that $150K using the 4% rule,
4% of $150K is only $6,000 a year.
add your CPP and OAS to that, maybe you get $30,000, $35,000 total income per year.
That's barely scraping by, a huge drop in living standards.
It likely means needing to work part-time well into your 70s or relying heavily on government support. The key point the sources make is this. The difference between the $70K plus retirement and the $30K retirement wasn't the starting salary. It was the discipline to save that 15%. So if math is so compelling, why doesn't everyone do this? It often boils down to mental roadblocks, excuses we tell ourselves.
Let's source and tackle these head on. Right, let's go through the big three. Excuse number one. I just can't afford to save $940 a month right now.
The counter is twofold. First, the stark reality. Can you afford not to? Can you afford that $30K retirement? But more practically.
Third, smaller.
Exactly. Don't let perfection be the enemy of the good. If $940 is impossible today, start with 5%. For a $75K income, that's about $312 a month.
Much more manageable for many people.
Get that automated. Build the habit. Feel the win. Then commit to increasing it systematically every raise, every time a debt is paid off, like a car loan ending. Bump up the savings contribution until you reach that 15% target.
Build momentum. Get started. That's the key.
Absolutely. Starting small now is infinitely better than planning to start big later. Time is your most valuable asset here.
Okay, excuse number two. Fueled by scary headlines. Markets are too risky? What about a crash?
Totally understandable fear, but the perspective offered is that market volatility isn't risk to be avoided. It's the cost of achieving those higher long-term returns, like 8%. You don't get the reward without the bumps.
And over 25 years, history shows markets recover and trend upwards.
Plus, the strategy itself helps manage risk. By contributing that $940 every month, you're doing something called dollar cost averaging.
Meaning you buy shares whether the market is high or low.
Right. You automatically buy more shares when prices are low during dips or crashes, and fewer shares when prices are high. It smooths out your purchase price and actually benefits from downturns in the long run.
So consistency beats market timing.
Statistically, yes. Trying to jump in and out is usually a losing game. Staying invested, even through the scary times, has historically been the winning strategy. The bigger risk is often being out of the market and missing the growth.
All right, the final excuse, maybe the most common one. I'll start later. When things settle down, I earn more. I have more time.
Procrastination. And the sources are brutal on this one. Delay is incredibly expensive due to the loss of compounding time.
How expensive? Let's quantify it.
Yeah.
Say you delay starting this plan from age 30 to age 40. 10 years.
That first decade is when your contributions make up most of the balance, but it's also when compounding gets its initial foothold. Losing those 10 years of early growth is devastating.
What does it do to the final number? If you start at 40, save the same $11,250 a year for the next 25 years.
Instead of reaching $1.28 million, you might only end up with around $600,000, maybe less.
You literally cut your potential retirement nest egg in half just by waiting 10 years.
Or worse. That lost decade of compounding is almost impossible to make up later, even if you save more aggressively. Time is the magic ingredient you can't get back. The message is urgent. Start now, even if it's small. Hashtag tag outro, key takeaways, and final thought.
Okay, we've covered a lot of ground. Math, habits, taxes, psychology. Let's boil it down to the absolute key takeaways for you, the listener.
1. That mindset shift. Paying yourself first isn't optional. It's the mandatory first bill you pay each month. Treat it like that.
2. The numbers work, potentially. A 15% savings rate on an average income like $75K, aiming for historical market returns around 8%, can build over $1.2 million in 25 years. It's mathematically plausible.
3. Use any starting capital you have. That initial $20K, RRSP, 5K, TFSA. Get it working immediately. Don't let it sit in cash.
And 4. Be smart about taxes. Use the RRSP for tax breaks now, especially during peak earning years, and use the TFSA for tax-free growth and withdrawals later. Optimize the mix.
The potential payoff. A retirement income that could rival your working salary, giving you real freedom. It's achievable through consistency. So here's the final thought we want to leave you with. The math, the principle of compounding, it's universal. It works the same way for everyone. But your specific strategy needs to be personal. Your goals, your comfort level with risk, your specific tax situation, they're all unique.
Which leads to the final piece of advice often given in these scenarios.
Talk to a professional, a qualified fee-based financial advisor. They can help you tailor this blueprint.
Help you pick the right specific investments, like low-cost ETFs or maybe some dividend stocks. Fine-tune that RRSP TFSA balance for your exact tax bracket.
Exactly. And maybe just as importantly, they can provide accountability. Someone to help you stay the course when markets get choppy or life throws curveballs.
So the math shows it can be done.
The question isn't, can you retire comfortably in 25 years on an average income? The question is, will you take that first step, automate that first payment, and start making it happen today?